ISC quick tip. What up, Investor Nation? Ratsby Ryan, host of ISC Quick Tips. And we're back with Harry Murray, head of Underwriting iFund Cities. Welcome, Harry.
Thank you, Ryan. Happy to be here.
That man, avid Eagles fan. This guy's a savage. So today we're going to talk about everybody's favorite topic, how to underwrite loans so you can come in and get that paper. Okay, how to underwrite your own deal before sending it to us, Harry. What would be the tips for the borrowers?
Yeah, so the first thing I think about when I open up a loan, the first thing I'm doing is looking at the property and immediately going to Google, looking through the property, walking the streets. And we always talk about kind of building your own type of market analysis on that. It's the most simple thing you can do is look at Zillow, Redfin, all these free resources online. Look at what's going on around that property, what's selling, what's not, bed, bath count, price per square footage. The biggest pickup you can have is to be prepared and know your market, know the property, know the project before putting it in front of us.
And so when you're looking at a loan, you're doing all that. What are things that stick out to you that would cause a loan to either have a reduction in leverage, a reduction, increase in pricing because of risk premium? What are some of those things that the borrowers are looking out for?
Yeah, I think the biggest thing is kind of the expectation versus reality. And so a lot of times you'll have somebody come in with a project where they're anticipating an exit sale of maybe $1 million. And that could be, we're building a new construction product that's 3,000 square feet. I'm looking at what's actually moved in that market in that exact neighborhood. So when you're looking at like those tools I mentioned, the Redfin, the Zillow, maybe you have a house that's sold down the street for $800,000 with a very similar floor plan, same bed, bath count. Right there, we're going to go, all right, well, that doesn't, you're not fitting the market there, the mold for that project. And likely we're not going to be able to, we're not going to get comfortable with that value of $1 million. On the same similar line, but different note, if you are within line with that price per square foot, and maybe that's whatever that dollar figure looks like, but the product is moving around that at $500,000. And you're coming in to do $1 million. Yes, the price per square foot matters, but you might be boxing yourself out of the market or the buyer pool there.
Sure.
So those two things are the biggest things we're looking at.
So on top of appraisals, if I'm hearing you correct, on top of appraisals, we're also looking at a price per square foot analysis and comp. So if you're building $1 million house, but the exit of that same square foot bed and bath is $750, and you're looking for $1 million, then we're looking for outside reasons why that would be $1 million. A pool, amenities, walkability, infill, right? And making sure we have kind of like comparables. Is that accurate?
That's exactly right. I think an appraisal is a great tool that we use to drive a value, but ultimately not the end all be all, which a lot of investors would imagine. A lot of times you can look at an appraisal and some of those are cherry picked versus what to the product that we're projecting by looking at it. So kind of adding into what we talked about earlier as far as being prepared and sending us the right stuff would be, like you mentioned, the amenities. What are you actually going to build that value? So if that project is overvalued to where we see the market selling, what's the reason for that?
Yep.
The appraiser should have that marked.
And I think ultimately the borrowers think, we're adverse to their project. We're not. We're actually trying to protect you because we've seen, over $3 billion in loans. And so in that you see patterns, guys, right? And those patterns are what we're trying to protect you from. So when you say it's $1 million and we're showing you the data historically and current at 750, it's so you make money.
Yeah.
It's not so we decrease your leverage and put you in a loan that you're upside down with, and then we're having an argument in 12 months. I think that tension is good tension, and borrowers need to pay attention to that, because if a lender who's seen this kind of volume is telling you something in the market, they're trying to help you. They're not trying to hurt you and not do the project. All right, so what makes a deal financeable versus just profitable on paper?
Yeah, so this would be very similar, kind of what I would consider your projections versus what's actually happening currently. So when you think about what's financeable versus profitable, I always think about how do we actually as a lender, get paid back.
Yeah.
That's what we're looking at to finance, not necessarily how profitable you're projecting that to pencil out.
Sure.
You have, a leased up property. We're going to be looking at that lease data versus you might be renovating it a little bit. Now you're projecting a pro forma with rents at $3,000. How does that actually stack up to the market? How realistic does that actually look?
I also think where I see some people fall down, or borrowers maybe could improve, maybe first fall down, is like they're missing some of the big costs, the impact fees, the taxes, the insurance costs to carry, right? It's not just your interest rate. These other factors in your pro forma. And then having a dual exit strategy, right? Today's important. Houses may not move as fast. You got to have some extra carrying costs. That interest is going to eat into your profit margin. Also, your interest rates are higher, so your cash flow might not be as high on a, PITI, right? When you're right at the refinance of the project. So I do think giving yourselves a bigger window and a longer duration is important when you're factoring in, a little buffer, right?
Yeah.
Projects. I mean, are you seeing the same thing in underwriting?
Exactly. I think to add on to that, one of the most important things from underwriting a deal is you're looking at what happens if one minor shift, so stress testing these projects is super important. A 5%, a 10% on rent decrease, sale decrease. And ultimately, when we consider financing a project, it's if you're projecting it and everything has to fall into place just to make some profit, that's not really a financeable deal for us. You need to have cushion there in case. So if we're looking at maybe a 1.15 DSCR on the exit, but right now it pencils to 1, we feel comfortable there.
And an interest rate stressing, right? I think everybody learned a valuable lesson, myself included. I got caught in, 11 duplexes, get my ass smoked when interest rates ran from, 3.5 to 6. There's zero cash. In fact, it's cash in. And we've seen that a lot across our portfolio. Well, Harry, I appreciate you being here today and helping the borrowers, think about how they can bring, more projects into F1 cities.
Yep. Thank you.
Yeah, man. Go Birds.
Go Birds.